Good afternoon to all of our MMTs around the world and the people that trade for us in the US. What I would like to show again, I am going to show an overbought S&P 500 index. We had made a lot of money trading the index options. The calendar 2015 is very important to understand that this diagonal trend line and this green line that's rising is a 200-day simple moving average. What I am saying right now is that we're going to have another pullback. The earnings season is getting out of the way. We started out calendar 2015 with a very nice short that came down, and these were the volatility moves right here. These were the what we call to as a 1, 2, 3 triple top. On the third pass, we broke out up to 2110 on the S&P 500. This is how the year started. And basically, every time that we came down here, and we go all the way here, these are called double bottoms. Now, if you go all the way back over here where the trend line is, you can clearly see what had happened in the same 2014 correction. We went parabolically up. This particular move, though, has been done on very light moves. One of the things that I'm going to show you also is how every time that we put in these bottoms, we get to these oversold and these overbought areas here. This is a public chart, and this is what the public looks at. We're market makers. We have different data. However, we're at a major top, and we're going to pull back. And this is how the calendar 2015 has started. Here is the stockmarketfunding.com website. Now, every time that we posted our trades before the fact, before calendar 2015 even started, all you have to do is go in here and take a look, like right here. That was a monthly chart on the S&P 500. We talked about buying put options, and then when we got to the bottom, this is a cycle that as we move through calendar 2015 now, what it looks like today and what it's going to look like in 9 months from now. So we do encourage you, and here's another one, S&P 500 down here. They're all right here. And if you type in the search box, go like this, SP 500, and let's see what happens. So in that search box, you're going to find out all of the S&P 500 analysis that we trade, and we use call and put options, but you have a slew of S&P 500 trades in here, and then down at the bottom you can click and go all the way over here to 10. We know what we're doing, and we called this move that started out in January. Oh, another thing too, free trial tab, just click it, click the free trial, read the content, get started now. Go down to open an account, which you can do, go read the video, click on the tab, get started today. People that have less capital, and I will tell you the 25-20 rule is if your account is below $25,000, you can't do a lot of intraday trades. We're market makers, so we will give you buying power. So if you have a 500,000, if you want to get up to 5,000 times 20, you're going to get 1,000 times 100 equals 100,000 intraday. 200,000 intraday, you start a $10,000 account, you're going to have those movements there. So we really do encourage people to take advantage of all of our programs that we have to offer. We do know one thing beyond a reasonable doubt is that you can extremely benefit. Oh, not to mention, we have state-of-the-art. Our trading applications go directly to the floor of the exchanges. No middleman. So you know that you can get money. You can use our services with our market makers. What I am going to do now is move on to the weekly chart. We do have a pullback coming. We are overbought. What I have here now, this particular chart is a weekly chart, and I'm going all the way back in time to where we started this move. This is the end of 2011. And these moves that started in 2012, it all started in this particular year of 2012, and it had a lot of back end filling and whatnot. And so when we draw this particular diagonal line, every time we went up and we pulled back, we made another higher high. It all started right there in 2012. Now, the real big move in this chart of the S&P is that once again in calendar 2013 we went parabolically up. What does that mean? It means that the money on the sideline came in. It also meant this is the biggest reason. The short interest in the S&P 500 got walked all the way up. So as the S&P 500 went higher and higher, people that were short were losing their money, period. And 2014, we started it off just like we did right here in 2015. I'm going to bring that up for you here right now, everybody. Up, up, up. Here you go. And basically, when we had that pullback towards the latter part of the year right here, MMTs, I will show you very clearly, we called every one of these moves. This was a short right here, and we were at 2019 on the S&P, and we dropped right here to 1820. That was a very, very nice pullback, and then money came right back in, and we went long, and we have all of those things there. You can clearly see, though, that these particular bottoms right here, I'm just going to explain this to you very carefully. When we started out this year, I called for a big pullback, and we got it. And I also said that we had hit the bottom right here, and these were major weekly support levels right here, and bam, look at 1, 2, 3 weeks up to an all-time high on that S&P 500. Okay, to my MMTs, this was the last expiration on the call and put side of the market. What I'm going to do right now, I'm going to show you how we're going to make another big, super big trade using the S&P 500 index put option. What I have here, MMTs, this is a S&P 500 call, the 2095 call, and this is a call chart on the index. If you bought calls down here at $5, you're making a fortune. 10 contracts here, you would be making $25,000. Now, what I will tell everybody, there is no way that these call contracts are going to stay up here, and we're going to take the opposite side called the 2095 put option. We make a fortune trading the index options on the S&P 500. What I am going to show you right now is I'm going to show you a put chart and a call chart. And I'm also going to say that everybody that trades options in the public world and everywhere combined, 99% of the people have never ever seen a 2110 put chart. This is a put chart. It was at $120 right up here, and that date was on February 1. These contracts fell when the S&P 500 went up. Like I showed you, these contracts were $120. If you had 10 contracts, that would have been a $120,000 investment, and that investment right now would only be worth $18. What my point is, on this 21 put, which expires on March 6th, we are going to be buying this, and this is a put chart on a weekly chart. It pays a tremendous amount of what? Money. It is totally deflated in value. Now, this is a chart. It's a monthly chart on the S&P 500. And what I am here to say, we're going to make another fortune. On this particular move right here, that's a rising 10-month moving average. That's a 10-month moving average. And this is calendar 2015. And we popped and we went straight up. This is a monthly bar. And it started right here when we called the bottom. We bought call contracts to go higher, and we made a lot of money. And we bought put options, and we made a lot of money. Now, I'm going to slide this out of the way right here. And I'm also going to tell you, listen, you can get the buying power right here, and you can get in these trades right now, right here. You got a $10,000 account, you're going to get $200,000 intraday. Our market makers will be in the room with you. You will have the best platform in the world to route orders to the floor of the exchanges. Now, this 2110 put, that was $120, you guys. Now it's down here at $18, and it's a March put. And basically what I can show you right here, we also have a 227, which is a weekly. But I want you to see that these put options have been marked down tremendously, and the other side of this trade is what we call a 2100 call option. Now, everybody, let me show you how we bought these down here, and we got in these down here. We paid $4, and now they're at $22. So once again, on that 2100 call was bought out of the money. And this is a weekly chart, and that $2,100 call is up here. This is where it started out, everybody. This is where it started out. And the bull got massacred, everybody, because this 2100 call when we started out was up here at $25.50, and it went straight down here. Oh, yes, it did. And those lows were $2.55. And now if you had 10 contracts in 3 weeks, you're up $22,000. Oh, yes, you are. This is a $2,100 call, and it's inflated. And I would like all of my market makers who always make a ton of money here, is there's one thing I'm going to show everybody. I am also going to pull up a monthly contract. Right now, what you're looking at here are weekly contracts and how to make a fortune. Number one, you have to know the difference between inflated and deflated mathematically. Mathematically, algorithmic, in our high frequency trading app, it tells us now that this is extremely high over the last 3 weeks on a $2,100 call. Now, as I go back over here, I'm going to show you a 2095 put. This put option is 2095. And right now, we all know that we closed at 2110. But listen, we are experts in this, and we have all the live trades. This is going to make a fortune. It's time to get back on the other side of this market. Just let me share something with you. This value was $120 for the 2095 put. It was way up there, but guess what happened? When we rallied up for 3 weeks, these got down here, and the cheapest price that we own them at is $12.50. This is called deflated 2095 strike price put option on the S&P 500. And how do you hedge portfolios? You can join our weekly school. You can get trading capital. You will have the market makers, just like I'm doing right now with 30 years experience. You have to know when to get on the other side of this market. And I'm going to continue to show you another one. Here we go right now. This is a 2095 call. And I showed you the 2095 put. When we bought these, they were around $5. And the S&P index went straight up to all-time highs to 2110. Now, at the time when we bought these, it was February 1st. And the S&P had made all-time highs. That made the 2095 March weekly call go through the roof. Now, having said that, here's the exact 2095 put, the other side of the market, and we're going to be buying these, and it's totally deflated mathematically. You guys have got to remember, you don't have to have an experience. I will tell you everything that we do. It's all mathematically. It has nothing to do with an opinion whatsoever. I will tell everybody we're going to make a fortune on the S&P. The call side has worked. These are going to come down, and we're going to get our entries even lower than what you see here. And the strike price is a 2095 put on the S&P 500 index. I am going to show you guys a 2080 put right here. Now, it's a March monthly contract. And a monthly contract trades differently than the weekly ones that I showed you. I will tell you one thing. This monthly contract at a 2080 put, and it's right here. This thing has been marked down to tremendously mathematically lows, and this is going to pay a lot of money going back up. It is, like I said, it tells you right here. It's a 320 2015. The strike price is 2080 for the put side. Now, what I am going to do is I'm going to go ahead and throw in here on this put chart. This is a call chart. These call options, when we bought them, we got in right around $12.60. And they've gone straight up to $45. That means that this side of the market, on the call side, which is in the money now, it's a 2080 call, and it's right here, and the percentages are way up there. The last print was 45.74, and we are going to be buying this particular put right here as we move forward on a monthly. We're going to buy this at a cheaper price, and that's a 2080 put. So when the S&P goes down, these shoot up to the highs on a 320 column put strategy. When I'm going to show all of my MMTs, this is a call chart. 99.99% of the people that trade options have never seen a call or put chart. And you know what I'm talking about. For you people that are watching this video, you know exactly what I'm talking about. And you trade options with no way of knowing what's inflated, deflated. You're just like a gambler. Gamblers lose money. This is a monthly contract, 320 monthly, and it is the strike price of the 2080, but we also put in the $2,100 call on a monthly. It's not a weekly now. So when you go up here and you look at the 320, that is this call option right here. And this call option, we were buying it down here, and it was up and out of the money at the time. And this is where the S&P put in the low. We bought a lot of contracts here. And at $6, you're up to $31.40 right now. How to trade this S&P 500 call option weekly, monthly, various different strike prices. Our market makers are going to give you the entry and the exits. And all you have to do now is do what? Sign up for that free trial. I'm going to show you another monthly contract. When the S&P comes down, it will drop. It's at 2110 on Friday. But this S&P is going to drop. And right now, I'm going to show you what a inflated call option on this index. We bought these right here. At the time, the strike price was $20.75. So the higher you go above $20.75, the higher the call goes in value. So if you had 10 contracts of 20, you're making about $50,000 on a very low dollar investment. So you had $10,000 invested. So what? They're worth $50. They hit the high, and they're getting up here in the high side of the contract now. On the put side of the 2075, when the S&P was going straight up, look what happened. This put option was $100, man. So when the S&P went straight up, these went straight down, and I and the rest of my crew, we're going to be buying this 20 monthly contract S&P, and we're going to start building the positions over the next couple of days. This is mathematically what? Deflated. Okay, my friends, what I have here right now is a 2090 call on the S&P. Right now, the S&P closed at 2110. You have all the charts in here. Now, when the S&P had hit a bottom, we bought a lot of these contracts down here at $6. So if you had 10 contracts right now, you're making $32,000 on a $6,000 investment. Now, after saying that, this is a 2090 call. And I'm going to make sure that this is totally in the video here, because we're going to be buying the 2090 put, and these are monthly contracts, 320 strikes. The other ones are weeklies on a 3/6. Here's what I want to show you why we're going to make a lot of money. These contracts were over $100. These contracts are totally deflated in value. So each little move that the S&P goes higher, these go down in value. Yes, they do. We have covered all the strike prices for the month of March monthly, 320. 320, here's the 320 call. Here's also a 320. Basically, what I have showing you right now on the screen is a March monthly put, and it is now down here. It was well over $120, or yeah, it was close to like, I can give you the exact price. Listen, this side of the market's deflated. When it goes down some more, we're going to buy it. The high end of that contract, the value of this contract on February 1st was $127 in value. This is the put side. So as that S&P does come down, like we say, we're going to be buying all of these calls and puts. We have a weekly 2110 put. We have a weekly 2100 call. We've covered the call for 320, 2100 call, 2100 put, 2095 call in the money, and we're buying the 2095 put. Here's the 2090 put that we're buying on a monthly, and this is the 2090 call. That's totally inflated in value, and these are the options that we're going to be trading on this S&P 500 index. And in this video, you're going to have all of that, and for the first time ever in your life, you've seen a call chart, you've seen a put chart, you can understand that we're market makers, and you can understand we're going to make a ton of money when this S&P goes down. We made a ton of money going up, and we're going to make another ton of money